Hello, everyone. Steve Ankerstar here, and thank you so much for listening in. Today, we're going to talk about how down markets can actually be healthy. So, we talked about how markets in the last episode can go up over time, but today, we actually want markets to go down sometimes to, again, give them a chance to grow in the future. So, that's what we are going to talk about today. But before we do, as a reminder, this is an educational show and should not be construed as personal financial advice. Full disclosure information is available at ototnow.com. Now let's get started. All right, so I know I've been there, you've been there. We were all there in March of 2020. You were there maybe in 2007 through 2009, maybe December 2018. There was a time in early 2016, I think it was Brexit. We've all been there when we got to see the nice, pretty big numbers, profits from a market that's gone straight up and we're all slapping high fives and everybody is a genius, to a market that starts downhill. Now, there's different levels of downhill. There's a normal downhill, a reversion to the mean. There's a correction down 10% plus. There's a bear market down 20%. Then there's a straight up crash. And there's no doubt that March of 2020 for COVID-19, that was a crash. There was very little time to get out. You had to make big, bold decisions. If, I happen to work in the business, so I'm staring at it all day long, but if I had still been in the military, there's no way I could have given this the amount of time and thought that I needed to be able to take care of my portfolio. So we're going to talk about all those things today in slow chunks, and just to put things in perspective. And I will tell you, the first thing you need to do is you need to think about your goals. So if you're thinking about your portfolio is like we talked about in 2 episodes ago, you're going to turn into a pension when you retire, then its value on, pick a date, March 23rd of 2020 or December 23rd of 2018, or any other date literally in your history, it doesn't matter. It only matters where you get to the end of the road. So along the way, before you hop on this train called long-term investing, just know that it's not a straight line. There will be huge up years, there will be big down years, and a lot of times you just can't see them coming. Many will tell you that you shouldn't even try. I think that's a touch passive for me because generally there's all kinds of warning signs, but it is difficult to make big, bold moves with your portfolio. I get it. I understand how you're feeling. But if you are what I would call the scaredy cat of every time the market starts to go drop a little bit, you want to go to the sidelines with your cash. There have been lots of studies done that even if you invested on, the worst 10 days ever, the highest 10 peaks ever, over the course of a 100-year history, you're still, averaging 10% a year, even if you had horrible entry points. So the big point is you need to, while you're along the journey, you need to ride much of this out with your best of breed names. And then on the edges, you can make some changes to your portfolio as you face the ups and downs. So that's kind of the big picture philosophy, is stay focused on your goals. Now, for you, those of you out there are saying, hey, that's not me, I'm within 5 years of retirement, then yes, you have to look at things a little differently and you have to be more conservative because you are there. You are at the end of that road or close enough to see the end of the road, and you'll stay invested in retirement, don't get me wrong, but all of the risk of taking full market risk along the way and enjoying or not enjoying, I get it, the ride, you need to kind of dampen things as you go into retirement and turn your portfolio into your pension, which again generates income so you can live off of. So we're talking about mostly the investing years from the time you start, hopefully before you're 25, if you're fortunate enough to be able to do so and disciplined enough to do so, or all the rest of us that are in between. So so you don't want the market to go up forever. We've seen this a few times in history. Excuse me. The most notable time was in 2000 with the tech bubble. Absolutely straight up, party like it's 1999. Yes, sir. Remember it well. We all did. And you were literally printing money in the stock market. And then it was great until it wasn't, is one of the phrases I love to say. So do enjoy the ride. However, it came to a screeching halt, and a lot of us were hurt badly. But if you didn't sell your Microsoft during the crash, then you were also able to pick up the 10,000% move up after that. So it all kind of comes down to how you handled that. And we're going to talk about that. We're going to use a roller coaster analogy throughout this. But you do not want markets to go up forever. The worst thing that can happen is for, as a long-term investor, is for the market just to go up, 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 and you're not close to retirement. So think about that. When the market goes up, stocks get more expensive. What are you doing every month? Are you selling stocks every month? Or are you buying stocks every month? Every single month you're buying stocks. If you have a traditional job, or if you're an entrepreneur with a SEP IRA, or anybody else who does dollar cost averaging, which is 99% of the people that are in the market, is you're plugging in a chunk of money over time. And if you do it once a year, guess what? That's still dollar cost averaging. It's just over a different time frame. You're doing it every January. So people who tell me, I don't put it in my IRA in January of every year because I like to dollar cost average, it's like, well, you clearly don't even understand the words you're saying. You're talking about monthly dollar cost averaging, where you can do the same thing over a year time frame. It's no different. So you are, along the way, a buyer. So from the time, say you start at 25, if you did before that, fantastic, high fives for you. I'm proud of you, and you are going to reap the benefits of that. But if you simply invest from 25 to 65, the average kind of ish retirement zone, that's 40 years. Now, if you're going to buy for 40 years, do you want the market to go up and stocks to be more expensive, or do you want them to be down and be cheaper? Yeah, think about that. You don't need them to, you invest when you're 25 and the market triples in the first 2 years. Well, that's fantastic, but you also pay 3 times as much for the next, 37 years you're having in the market. So if anything, it would be nice from when you started investing, if the market went down, if you were to craft it in a perfect world, it would go down for 40 years and then explode up higher the day before you retired. Now that's a ridiculous example, but when the market faces a downturn and you are not 65, then you should applaud that. Now, what gets you is your emotions here. Is you bail on the math. You're not like, hey, am I a buyer or seller here? Well, most people aren't selling. You're in the acquiring phase. So if you're a buyer, you would like it cheaper. But what you're looking at is your app, or you're logging into the computer, for those that still do that. But you're seeing what was a big number get smaller, and that's your total portfolio balance. So you lose complete sight of the fact that you're actually buying on a monthly basis. And actually, stocks getting cheaper would benefit you because you can buy more shares while they're cheaper, knowing that it trends up over time, But no, you're all bent out of shape because your $200,000 just became $160,000. Or when you get up into the big kids ball game and you have 7 figures, yeah, if you have over 7 figures and the market corrects 10%, yeah, that's $100,000, kids. It's just math. Now, you may be like, well, I couldn't stand losing 100,000 in a year. Well, if you don't understand that math, you probably don't have the discipline and math skills to understand how to get to $1 million. That's why you need to transition to percent. Because if you start thinking raw numbers, it's going to mess with your head. You're going to get your emotions involved. And who does their best thinking when all their emotions are involved? Nobody. In the flying world, we teach one thing. When you have an emergency, jet starts on fire, you get hit by a missile, your wingman gets hit by it, doesn't matter. You wind the clock. You slow down. You analyze the situation. You take the appropriate action, and you land when conditions permit. And you methodically go through it, and you separate yourself from the entire emotion of the I'm about to die light flashing in your cockpit, because you may be, you don't know. So you need to divorce yourself from bad decision making, which is Mr. or Mrs. Emotional, into let's just think about what are we really doing. Sometimes it's help zooming out on the chart to take a look at oh yes, I know it sucks that your portfolio is down 10%, but you were also up 30% last year. So maybe we could not be like super greedy today and understand that that's a simple reversion to the mean. That if markets average 10 to 12% over history and you have a 30-year up market in a year, guess what? That really makes the odds of the next year actually even negative, and you're still up more than the historic average during that time. So if you look, the best example I can think of a very simple reversion to the mean is going into December of 2018, which you may remember. Is 2018 was an up year. We're up, 15% on the year, high fives. Everybody's a genius. Hey, Steve, look at my stock picks. And I do. And I'm like, oh, I don't know if I'd get into that junk, but it really doesn't matter, because when the stock market's going straight up, all the junk rises with it. You don't find out what kind of terrible investments those are until the market starts falling. And then those things go to like zero. But the point is when the markets go up, like in 2018, we're up 15% going into December. December of 2018, we dropped almost 20%. It was almost a bear market. It was actually 19 and change. And if you go intraday, it did drop 20%, but you don't get to count that. It's where it closes. So we technically didn't go into a bear market, and we kept the bull alive. Well, the fact that that happened in December of 2018 made 2018 arbitrarily a negative year in the market, negative 5%. Guess what? It all snapped back in January of 2019, and 2019 ended up a 30% up year. Well, I don't want to burst your bubble, but if you move that event that dropped 20%, if you just move that to January, then 2018 all of a sudden was this really awesome year. And then 2019 was, took this huge hit at the beginning of it and then made up for some of it. So it's kind of like, that's reversion to the mean. So you take it from a 2-year period, divide the returns by 2, and you get the average return over the period. So who cares what happened in January versus what happened in December? And honestly, if you're hung up on performance, you're going to get into what's called short-termism. So you're going to, think short-term, and you can't think of it. That's short-term is dating. So dating versus marriage. Well, guess what? When you get married, obviously you went into it with the thinking that the person you're with is the person for you, maybe your soulmate, maybe you're marrying out of your league like I did. And it's like, I better marry this one because it's not going to get any better for me. That's for darn sure. Whatever your thought is going into a marriage, you at least have to acknowledge going in that even if it was perfect up to that point, you're not really going to expect perfection for the next 20, 30, 40, 80 years, however long you're married, right? There's going to be rain showers in paradise. There's going to be times where you're very upset with each other. There will be bad days, weeks, months, hopefully not years, but that can happen too. If you know that going in, that makes it a lot easier to go through those moments. So when you say, I do, you repeat all those fancy things. Most of them say till death do us part or something along those lines. You don't go into it with the short-term mentality of first argument, man, I'm out, see ya. No, because then you will, obviously that will not end well for you. And then you will probably do that sequentially several more times, right? Because you have not matured into thinking about how things long-term. So enter it like a marriage. Investing is, there will be ups and downs. It will be a roller coaster. So if you can picture one in your mind, yeah, when you look at it standing there before you get on it, you're like, oh yeah, there's some ups and downs there. I see it. When you get on it and you're going through the ups and downs, it's a lot different than when you're standing there watching somebody else to do it. So just make sure you're kind of up for it and you understand it. So that way, when you see a down market, you're not really even going to be phased. Okay. So we talked about reversion to the mean. That's kind of, so let's talk about the grades of down market, if you will. Well, markets fluctuate on a daily basis. You know that. And on, if you go down 2 or 3% in a day, all those same people get on CNBC and squawk about, I told you so. Well, these are the people that are wrong like 95% of the time, and they get to be right. And guess what? They're available for TV that day. Yeah, right. Because they wrote a book about how markets are rigged and they're all going to crash. And then they get to be wrong their whole life. But you know what? They look smart on a couple of days. So that's when they get on TV. But when you think of a move down in a market, whether it's aggressive like we saw in March of 2020 or it's slow over time, if markets come in 5 to 8%, that's generally a reversion to the mean, especially if markets have run up like they did from 2009 to 2019. Not quite in a straight line, but for the most part, it's like, hey, it's going to happen. So you're not even phased when a market comes in 5 to 8%. If you are, you're kind of hanging on too tight. Or you're approaching retirement, which means, okay, now I really want to start locking this stuff down, or you're just very conservative by nature. And that's not wrong. Just know going in, just like you do with a roller coaster, if you know going in, there's no way I'm going to get on that thing, then don't get on it, right? Now, you'll just may have to work a decade or two longer than anybody else who chose to get on it, But hey, that's your decision, right? So 5 to 8%, that's a normal reversion to the mean. So it's what you can expect after a big 30 plus year. 2019 was this huge year. Nobody guessed what 2020 was actually going to be like, but it was not expected to be a huge year. Contentious election coming up, maybe try to eke out some 8 to 10% positive. But hey, nobody saw what the COVID-19 to come rolling in. But that's a 5 to 8% think reversion to the mean. So a correction, now it's more of a street definition than a technical definition, but a correction is 10% down. So you will hear when markets enter a correction, that means they're over 10% from all-time highs. So if you started when you're 25 and you invested till you're 55 and you've made over that period, I don't know, 700-800%, and the market comes in 10% and you start calling and freaking out, you've probably lost a lot of perspective. Yes, the numbers are getting bigger, but you're looking at whole amounts, not percentages, and that can mess with your head. So don't be greedy, thinking, well, gosh, the only amount of money I've ever put into this is $150,000, and my portfolio is worth $800,000. Now, you may not be excited when it drops to $700,000, but keep it in perspective. That's all part of the ride. So know that going in. Corrections happen. No big deal. Stocks get cheaper. If you are still working and plugging money into the system, guess what? You're picking up cheaper shares. If you have a bunch of shares and you're reinvesting those dividends, guess what? You are picking up cheaper shares. There is a silver lining in down markets. If you don't add money over time, you may consider adding money in a down market. Think of that. If a store runs a sale, most of us, like if you're going to buy a sweater, you would go to the store when there's a sale. Investing is the only one I know of where the sale happens and people are running from the store. Like that makes no sense. So don't forget, during the acquiring phase, you are a net purchaser of assets. You are acquiring, you're hunting and gathering, or if you're going for total return, you're going for kills. It kind of doesn't matter. You are trying to make money during that time, and cheaper shares are the way to do that. Okay, once it goes past 10%, now 20% is the bear market. These are going to happen. I guarantee you that, I'm 50, I'll see at least one a decade. Maybe more, maybe less, I don't know, but that's about right for a big move down. I kind of hope that COVID-19 was it, because that was the fastest move down and back up in history. I could go for being a little slower, but hey, I'm paying attention. I'm sitting there staring at it all day, every day. So I'm poised to benefit more than anybody else. And it is kind of a relative thing. So, it is what it is. But when you think of a bear market and it's already gone down 20%, at that point, your decisions time is behind you already. So if it goes down 20% in a day, then you lost that decision time, right? So it's just, we're here and you have to accept it. So I use the analogy of a roller coaster. You've heard that, but I want you to think that there's only two places to get off the coaster. Two places. That's when the coaster is going up and that big long stretch up and you're approaching retirement and you're hearing that chunk, chunk, chunk. You can kind of picture in your mind, you can hear that sound. You're looking off to the side at how high you're getting. You can picture the last time you were there. And then you kind of look at the top. And of course, in investing, you don't know when the top is, but I bet you feel it. I bet you do. A little bit that's emotions with you, but also it's, it's gone up for 10 years and you're a couple years out from retirement. At some point in time, it's greed got you there for sure. You want to take advantage of the greatest wealth creation mechanism we've ever known, but also you don't want to be too greedy and stay at the party too long. So, I talk about keeping one foot, after midnight, keep one foot out the door, right? Because nothing good happens after midnight. We all know that. But from an investing perspective, if you are still going up, you can step off and transition to a more conservative strategy, lock in your gains, get boring, if you will. And yeah, you're giving up the rest of the move up, which you don't know what it is. But you've locked it down, you've made your money. So why continue to take the risk once you've made your lifetime money? Okay, so think about that. Why do you still continue to take the risk when the risk got you to where you are today and you're going to have more money than you're going to need to live your quality of life? We all could spend more money, right? But for whatever your quality of life is, you've got that made. Why would you risk more? So that's the first place to get off the coaster. The second place to get off the coaster is right past the top. So this is for most of us that are on the accumulation phase of, you know what? We're now looking at that 5%, 8% down during that reversion to the mean. And we have to ask ourselves, is this the big one? Yeah, pandemic. Yes, kids, that's the big one. Yes, it is okay to start taking money to the sidelines. I mean, I'll hold my shares of Apple because I don't really care, because I know where it's going to be 10, 20 years from now. Same with, 20 other names out there that are best of breed. But if I'm off into some speculative little thing that I think is kind of fun to own and has a lot of upside, no, you ditch that like a heartbeat. When you at that 5%, 5 to 8% down, and you're sitting there looking down at the coaster, and you've all been there, and you're looking at the bottom and going, holy crap, we're about to go straight down. Yes, take some money to the sidelines if you don't like what you see. Worst case is you're wrong, market goes back up and you put the money back in. But once you get past that 10% down, you've really gone past your chance to take things off the table. At that point, it is lock up what you got and hold. You may hold for a month or 2 months. Like, COVID was like snapped back so fast. It was just as impressive on the way back up as it was on the way down. But other times, even Japan faced a lost decade. That can be a long time. But when you enter a down market, a bear market, you need to lock up your assets, let the market do its thing, let the coaster do its thing, and reinvest the dividends along the way. Continue to plug into your 401k or IRAs on a monthly basis. Just get into your disciplined dollar cost averaging. Stop looking at the news if it's messing with your head. Stop looking at your portfolio 15 times a day. That you're not helping anything and you're not affecting anything. So go live your life, go do your job, go hang out with your family, go be with your friends, all that other stuff that's actually far more important. Stop obsessing over the market when it's going down. It will turn around and come back up, and then we can all get back out and slap high fives again. So you have to think, when a market starts moving down, is this a big one? If so, go to safety, maybe cash. You can even turn around and look at going short if you know what you're doing. Don't if you don't. But have a reentry plan, though, and don't expect to catch the absolute bottom. The bottom fell out during COVID. I went to cash with some stuff and just took the ride on the rest. But at the bottom, I called March 22nd. I was a day early. March 23rd, it went rifling right back up. And you know what? Couldn't be happier at the end of how it all turned out. So think about the long term. I'll leave you with a Warren Buffett quote. And he said, quote, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. So think about that. When people tell me they want to buy Netflix, and Netflix is at $500 a share, and I'm like, well, it's overpriced, but if you want it, buy 10 shares, buy a few shares, just buy some so you have it. If the market goes down by 50%, I want you to buy more. So if they're like, what are you talking about? It's like, well, don't buy it today if you would turn around and sell it tomorrow if the price dropped 50%. You want to buy it today and turn around and buy more tomorrow if the price dropped 50%, because you don't care. You think you got a deal. Most people think if they buy something and it drops in half the next day that they think that they were wrong. You aren't necessarily wrong. I mean, I like to say none of us is as stupid as all of us, and the market is all of us, and it can be stupid. So if you think that you have something you would hold for 10 years on Monday and Tuesday gets chopped in half, well, clearly you would buy more, right? Because now you're getting even a better deal. So make small moves when you enter positions, scale in over time if they go down. If they go up, you're happy because you just bought a stock and it went up. If it goes down, you're happy because you're going to buy more of that stock, because eventually when it turns around and goes up, then your thesis was right. So focus on the long term. All right, covered a lot of stuff there today. Next episode, we'll talk about financial therapy, which is a big piece of this as well. But just realize that it is very healthy for a market to enter these downturns, whether it's a reversion to the mean, a correction, or even a bear market can be healthy for the long term. So that's all we have for today's episode. Please reach out through OTOTnow.com with any questions or comments. Thanks again for listening, and here's to you fighting the good fight every day to be on time, on target with your financial goals. Bye.